From the morning reading, the Qs lead bounce with gains in Facebook, Amazon, Gilead, Cisco, Celgene, and Microsoft. Healthcare sector leads the SPX. All 9 sectors moved higher on Wednesday. XLV, XLY, and XLK were the strongest sectors, while XLP was the weakest sector. While futures rose 91 cents to close at 46.86. Breadth strengthened compared to the prior day as advancers led 1924 to 1061 on the New York Stock Exchange and led 1633 to 963 on the NASDAQ. The Federal Reserve is concerned about risk. Over the past 6 months, they have mentioned risk in their meeting minutes more than 70 times. There have been 2 other times that they have persistently mentioned risk over a 6-month time frame, and both of them are in the beginning stages of bear markets. Notes and bonds are beginning to see an exhaustive move. We've used the triple time frame view of returns to get a balanced short, medium, and long-term perspective on markets. Most recently, crude oil late last year. The same type of analysis is showing that the 10-year T-note yields are at a point that has indicated exhaustion in the past. Biotech enjoyed another big day. Wednesday marked the 4th gain of more than 1% out of the past 6 sessions, coming on the heels of what had been a 52-week low in the NASDAQ Biotech Index on June the 27th. As shown in the premium notes, this has typically led to further gains in the sector, especially longer term. 6 months later, biotechs have rallied further 10 out of 13 times, averaging 12%, and with a nearly 2-to-1 reward to risk ratio. A lot of utilities have been hitting new highs. On July 1st, more than 80% of the stocks in the sector hit a 52-week high, the most since at least 2000. Nearly 50% of the staples stocks are also hitting new highs. Both figures have tended to coincide with temporary buying exhaustion in the stocks, suggesting that these defensive groups are not especially attractive when looking out over the next several weeks. The Dow and the S&P 500 bounce off their 50-day averages. NASDAQ regains the 200-day line. Celgene and Merck lead healthcare spider to the highest level since August. Home builders lead cyclicals hires as Dr. Horton breaks out. DR Horton, I should say. Facebook also has a strong day. Market has upside reversal day after trading lower this morning. Stocks rallied this afternoon to respective gains. The upside reversal also helped the Dow Industrials and the S&P 500 bounce off their 50-day moving averages. The chart also shows the NASDAQ Composite Index regaining its 50 and 200-day moving average. All 10 market sectors ended in the black. The 3 strongest sectors were healthcare, cyclicals, and technology. The weakest were staples, utilities, and financials. Financials suffered from another record low in Treasury bond yields. The late rebound in those yields, however, may have slowed the advance in staples and utilities. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:02 a.m. Mountain Time, and I'm recording this in preparation for the market day of July the 7th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and bounce into our morning report. And a fairly quiet night, especially after what we've had so much of lately. And let's resize that just a bit for you. There we go. With the S&P futures down about 2 points or just below scratch. Russell down just below scratch, as is NASDAQ and the Dow. Crude oil up about 1.2%. Euro down about 0.25%. Bonds up just above scratch. And gold down just below scratch. In overseas action, China right at scratch. Hong Kong, though, up nicely at 1%. Japan down about 2/3%. Germany up about 0.75%. United Kingdom up about 1%. And macroeconomic reports for today of significance in the United States are nat gas storage and crude oil inventories. Remember, crude oil inventory report is moved to Thursday in weeks in which you have a holiday on Monday. And that looks to be about it for today in the United States. Going forward to tomorrow, you have the big one of the most important reports of the month, the non-farm employment change, along with its employment rate. So all that will be coming out tomorrow, and that'll be driving all the financial news media heads. Let's see about market conditions. Current volatility, a 13.18. Skew has now gone back to normal range, no longer in warning status. IV percentiles exceptionally low, with 2 of them in single digits and a third nearly so. The S&P at an 8, the Russell at a 25, the NASDAQ at 11, and the Dow at a 5. No standard deviation moves were put in yesterday on a close-to-close basis. So a bit of a break, and indeed 2 of the past 3 sessions have had no standard deviation moves, so that's quite a change from the cluster volatility that we had just prior to that. In terms of the current charts, let's go ahead and look at the S&P futures first. And you see this recent tag of the area of resistance and backing off from that, but then the bulls come back in, and the short-term pattern is basically just consolidation, all chattering back and forth in a relatively small area in the last now 4 trading sessions. In terms of where do we go from here? Well, so many of these indicators, and as we get into the daily report, you're going to see many of them are now bullish, many of them are in normal settings. The problem is where do you go in terms of if you're a bull? There's such a significant area of long-term resistance above you. It's hard to get excited about your prospects. Also, you've had, our typical heroes of the year, utilities, staples, long bonds, they all seem to be showing some signs of exhaustion, and we'll take a look at some of those symbols here in just a second. But it could be a situation where you start to watch for some potential weakness and perhaps maybe even sell some covered calls on some of those holdings. We'll have to watch and wait. But basically what this is telling us is what should we be looking for? What should we be watching for? And then be ready to act should those things start to materialize. Because the pot odds are so much more room to the downside than there is room to the upside, unless we truly see the kind of energy and momentum that's going to take to get through. Now, if we finally get through that 2134 area and get a confirmed close, a confirmed breakout above this area of resistance, that could become something that is significant to the upside, as all that pent-up energy, the frustration of not being able to get through that area time after time, money could come pouring in, and a lot of shorts could get run over very quickly if we should get to that level. But there is a wall of resistance between here and there. In terms of the Dow, very, very similar picture. And you see also in the last 4 days, very much a consolidation pattern. NASDAQ, also consolidating, albeit at a significantly lower high. We've been concerned about the NASDAQ and the Russell, for that matter, about these lower highs that have been put in across these recent swing moves. So we'll have to see if that leads to anything. Of course, now one of the markets that the morning authors were talking about and showing signs of potential exhaustion is the long bond. And you see we've had a really big move for bonds recently. In these last 2 trading weeks, we've gone from about 165, and we'll call it about 15 or so, all the way up to 177 with yesterday's action. So that's a giant move in a very large market that is most notable. So we're going to continue to watch that. We're going to continue to watch gold. Gold has also been breaking up, but it, along with silver, is perhaps showing some signs of exhaustion. And then others like XLP, also, you see it's set a new 52-week high with the session 2 days ago, 2 sessions ago. Yet at the same time, seems to be chattering kind of sideways. And then XLU also showing some potential signs of exhaustion. So these have been very, very, very strong places to go throughout most of 2016. We've got quite a few holdings in these areas in our own core portfolio as modeled in the trading room. And so we're going to be wanting to watch and protect these profits should exhaustion truly start to set up. Let's see, crude oil. Crude oil, of course, also been in a consolidation and kind of a worrisome potential breaking down below this consolidation pattern of late. So we'll see where that goes. You could start to draw something of an ascending triangle here. We've got a triple bottom coming across here, and then you can see where the diagonal resistance is coming across here. Let's go ahead and add those drawings while we're here. Let's see. Give me just a second. It is with the break of this diagonal resistance that we could see a resumption back into this former pattern. So also of note, if we were to see a breakdown, which would be the lesser probable scenario given the pattern coming into the triangle, that would be very, very, very bearish. So don't expect that, but we've kind of hinted at this a few times. But as you can see, we're starting to form a pretty good looking triangle pattern there. So we'll see where that goes. And then, of course, we toyed with gold here for a moment. Gold continuing to make this move up, watching for those signs of exhaustion. And then let's take a look at volatility. Been waiting to see if this volatility crush can get us down into that 13 handle. Frankly, we'd like in the trade room to put on some long-term protection, some vol bombs and other strategies. So been watching this to see if this can get down, but certainly there's not a lot of fear in this market. So this post-Brexit period has basically been absolved. Now we're past the FOMC meeting minutes. Really, what you're looking at now is the unemployment report for the monthly to come in with tomorrow. And then after that, it gets fairly quiet. We could enter a period of true summer doldrums. So that's also a real possibility, is that we don't break out to the upside, and we also don't break down, is that we just go sideways. Enough on the charts there. Let's go ahead and go to the daily report. We still have this kind of troublesome intermediate term phase opinion. We have this as market phase 5, the in short term, the break of horizontal and diagonal support. We haven't yet broken through the resistance to be able to flip that to a more bullish opinion. So that continues to kind of stagnate here in this kind of bearish opinion. But against that has been a number of improving signals, including some that came in with yesterday's session. Our first market timing signal from IBD, of course, confirmed uptrend. The second one from GMI Index is also in a bullish signal with a buy signal in place in 7-1. And then the third one had several changes yesterday from Stock Charts Decision Point Scoreboard. We had 3 new bullish signals on the short term. So if you look across, guess what? How fast these things change. On the short term, they're all bullish signals again. And then when we look at the next time frame up, Well, all but one is a bullish signal. NASDAQ still has one neutral signal. So all this up against the backdrop of the long term being a mixed signal, we have to kind of take the consensus now and start to say that the consensus of these three market timing signals is bullish. And yet we still recognize that we're up against that wall of resistance, and even the defensive sectors, utilities, staples, long bonds, dividend aristocrat type of positions, those Dow big cap global but dividend paying conservative positions, they're the ones that have been doing well thus far in 2016. And some of those are starting to show some signs of exhaustion. So if they're showing exhaustion, what's going to lead us up through that wall of resistance? Well, it doesn't seem, when you look at the charts, that NASDAQ or the Russell or those high beta areas are particularly ready to lead that charge. So this leaves us in something of a quandary as to what to make of these bullish signals. So just kind of keep that in mind. We're going to kind of put an asterisk by these signals at this point. Position sizing opinions both at 100%, as you would expect with the the market timing signals and so forth that we have. Intermediate term phase opinion, a very strong bull coming from the S&P at an 80. This goes into what we call the severely, anything over 80, severely strong. The most significant strong area. The Dow is already there. NASDAQ and Russell somewhat behind, but still, you got to give them their due. They're still in the strong bull category. So all four of these are at least strong bull in the intermediate term market postures. Hedge warning status, we have dropped this half a notch to a level 1. Still somewhat elevated in recognition that we're up against so much long-term resistance, while at the same time recognizing that certainly a lot of fear has come out of the market. Volatility started to calm down, and so many of our signals have gone back to their kind of normal settings. So we have to kind of bring that hedge risk level down in recognition of all that, and yet still in balance remain at our first level of elevated status in recognition that the pot odds for the long position have got such a limited opportunity, it would appear. In terms of option income strategies and other special opinions, no changes from yesterday. VIX is inside the acceptable window to initiate new positions. Just be kind of aware of where we are on those charts. Cover calls, put selling. We've been talking up until today about using some of those, those utilities, those dividend aristocrats, those kind of boring but dividend paying kind of stocks. Well, it might be a little tricky. So you're going to have to be pretty selective, pretty much a stock picker right now to choose what you might want to put a new covered call on. If you're doing this on dividends and you're doing a lot of in the money, you might be, frankly, kind of planning on being called out. So got to watch those intrinsic values on those in the money strikes with the cover call strategy, because that's always a possibility. If that gets under about 25 cents, you sometimes will see those get called out, and when a dividend becomes payable. So put selling, also the same situation. So we're really left with a pretty narrow window of opportunity to be able to initiate new positions, and that might be somewhat telling to us to begin with. So it may be that until this situation resolves itself, you go with very small position sizes, maybe play some short-term swing kind of trades, but keep the position sizes small to where you can't get hurt if we finally do see a significant move one way or another. Until this situation resolves itself, it's very hard to put significant new money on the table. As you see with the specific warnings, under the volatility, it's all black. They're all normal settings. There is nothing that says be concerned or fearful or elevated risk levels or anything there. So we've got to recognize that. In terms of the trend-based group, there's only that kind of questionable market phase 5, and we've said right along in recent sessions that we're a bit befuddled by this signal right now, and this short-term pattern has just kind of made a mess of this, as it were, right now. So we don't have a lot of confidence in that particular indicator at the moment. The one thing that has been consistently troublesome, though, throughout the more normalization across the other indicators has been the key intermarket risk aversion indicators. All 5 of those are still in the risk-off positions, though a couple of these are really close to turning to risk-on, and a third one clearly has started to roll up. But we still haven't changed any of these signals. So we'll continue to watch and see if we start to see some movement here to come into more normal bullish kind of settings. That being said, that's probably the one significant fly in the ointment in terms of indicators at this point. From a sentiment standpoint for stocks, pretty benign. You see the short to medium term. You also see the fear and greed index pretty solidly in the greed area, but not yet into the extreme. So nothing particularly exciting or extreme from sentiment. Now, that's not true with bonds and gold. Sentiment on bonds and gold are both getting into the extreme areas, so they would also suggest in a separate system to be looking for reversal patterns. And we heard from some of our morning authors talking about exhaustion patterns in some of these markets. And this is just another reinforcing indicator to say, look for those potential reversal patterns. In terms of sector specific, you see that financials and transportation and then perhaps materials are the 3 weakest sectors, though they have been somewhat improving with recent price action. The others, for the most part, pretty much bullish on all 3 time frames. As for performance yesterday, healthcare, consumer discretionary, energy, so high beta areas of the market, doing the best. Whereas our 3 defensive sectors, as one of the morning authors also mentioned, were the ones that really didn't make much headway. And in the case of telecom, that was the lone sector, pseudo sector. It's not officially a sector, but we included in this analysis as a separate group. Telecom was negative yesterday. There's some particular meetings and so forth, I understand, that have been going on that probably have been stirring up some news related to some of the big players there, like AT&T and Verizon. That should be enough for today. Let's go ahead and roll the sequence up. We're a little over 20 minutes. Disclaimers, as always, hit the pause button if you need more time to review this. And then, of course, always note the hyperlink down here at the bottom for the full set of disclosures. Meantime, manage that risk. Look for those real opportunities where your patterns give you the profit potential that makes it worth the risk. And then, of course, as always, we shall back here for the next trading session with our next market preview for Friday. Will be the next session. So in the meantime, thank you all from Falcon Global. Good trading.